buried in your note is the outlier what if, which is a multiple for the market out of another time and place. Can you actually multiple a gloom 12 times multiple on the market?
That would be our extreme left tail risk, but it is out there as a very low risk scenario when it goes something like this. And it's similar to the conversation you've been having this morning, which is that, earnings for the second quarter are expected to be up about 4.5%. But for the second half of the year, earnings are still up on expectations 10.5%. The second half, which I think is probably not believable. We expect margins must come down here. And the way that stimulus, increased the revenue side, it also increased the operating margin side. We're at record margins. That has to come down. So as earnings come down, the multiple will start looking higher if the market just stays where it is. And in a recessionary scenario, you could be down on earnings 10 to 30%. And with that, the multiple goes with it. So I would say an average recession multiple is 14 times. Whatever those new earnings are, expect it to come down 7 to 10% from here. And then you put the average recession 14 times, you're about 3,400, about. As a first stop before we can think about moving higher here. So we're in the chart. I think the rally in the last week or so is an expectation that PCE data that we're getting on Thursday is going to show some peak inflation. But once we've rallied 6 or 7 or even 10% into it, then where do you go, even if it is slightly peaky?
Alicia, that scenario you just painted, is that just a bearish scenario or is that your base case?
That is not our base case. That is a bearish scenario. But you have to start thinking about, well, if the worst case happens, where does it go? We actually think there's a 50-50 chance of recession in the next 12 months. So there's that bumpy landing, not really a soft one, but a bumpy landing, about 50% recession on the other side of that. But we do think the recession will be mild, meaning the job market is so strong and activity is pretty strong in the economy. We don't think we'll see anything deeper. The wild card, of course, is if there's some kind of contagion in financial markets. So if we get a market dislocation event, of course, that could make it worse. But right now, we're seeing this as a slowdown, an earnings slowdown, a mild recession, and then something we can build out of here. But I agree with your previous guest that tightening financial conditions is part of the Fed's solution to the inflation problem, which means, of course, the market will go lower as part of the plan.
So which equities do you see as probably bearing the brunt of the pain? And I'm thinking in particular of Goldman's call on retailers that are facing perhaps extreme margin pressure in the face of inventories and other factors that are much more volatile.
Look, on the consumption side, on the consumer side, it's all about the inventory to sales ratio. If you think sales are moving lower, and we know the inventory levels are up 30 to 50%. So the margins are going to come down pretty quickly, and it'll hit earnings pretty quickly. So I would say that's pretty much ground zero for where we see earnings revisions right here on that discretionary side. The stocks are acting like it. If you look at the staples versus discretionary, you can see the vast outperformance on the staple side. So that's where you should see the multiple compression and the earnings compression first. And you'll see it in the second quarter earnings as well.
Alicia, have we already reached the point at which it's time to start selling out of the energy positions? The idea that we've already seen that wager kind of roll over, and now people are more worried about recession and lack of demand. And so too, will the stocks reflect that?
So that's a great question. I mean, it's something we have to think about. We are bullish on energy stocks with WTI staying above 95. So on a technical level, over 95 means the energy stocks should probably still work here. We do think there's a structural issue. There's some cyclical component in the movement on the energy sector, but it's more structural. And as you've pointed out, energy's managed to move this high with China, with 1/3 of Chinese locked down. So to the extent that there's any demand from China coming out of a COVID lockdown situation, it should help support energy prices and therefore the stocks. You're probably not going to get that parabolic move. You know, we always talk about how parabolas don't make great technical charts, but we think it's too early to sell out here.